Welcome to Smart Money with Chris Swartz. Living life on your terms requires more than income. Smart Money connects you with the people, tools, and strategies that turn income into freedom. Today I'm joined by Steve Seymour, broker owner of VRA Realty, investor, and capital raiser focused on building generational wealth through real estate. All right, Steve, welcome to Smart Money.
Thanks, Chris. Appreciate you having me on today.
Absolutely, man. Well, thanks for joining us. I'm so excited to dive into this conversation. So many people have questions about real estate and building wealth, and I'm just really grateful to have you on the show today and really dive into this.
Happy to share anything that I can that might help someone. So we'll see if we can get some valuable information in this episode here.
Oh man, for sure. I know you've got all the good nuggets here. So I'm going to talk about, a little bit about what you do, and really I want to dive into how did real estate become your path?
So real estate became my path through, having my dad be a major influence in that. Not that, he had a few rental properties, but he was primarily a contractor and home builder. I was out on job sites when I was 4 years old, and when you're a kid, your dad's your idol. He still is to me. He passed away in 2022, but, I love my dad, and he had a major influence on me. Just being around construction my whole life, I had a different level of understanding of, what was most instrumental is, the time when I was getting ready to figure out my career path. My dad said, why don't you really look into real estate and look into getting your real estate license and buying rental properties? He really pushed that. That's how I got into it.
So it was like on the residential side.
Yeah, I got my license in 2006, so 20 years now, because I saw pretty quickly, that you could tell from this, I'm not a salesperson. I'm not cut out for sales. It's just not my personality. I did okay, put the work in, sold a couple million my first year or whatever, but that was not going to be my pathway to financial freedom. And in my office of 140 agents, I really was seeking out guidance on investing. I couldn't really find that internally, and luckily I got introduced to a group of real estate investors and stumbled in a room with a mutual acquaintance of ours, Greg Davis. I know you're close with Greg too. Greg was really helpful to me in, introducing me to DIG, Diversified Investor Group. I can't take credit for anything that I know. It's all from learning from other people and just monkey see, monkey do, watching others succeed in the rental business. But I got into flipping, wholesaling, buying rental properties. Then I became my own broker because it didn't make sense for me to be educating my broker on the types of deals I was doing, since they didn't fully understand, the creative world and the investor world. It's just, you would think it's very similar. I think a lot of people have this idea that if they get their real estate license, that's going to be a good stepping stone to investing. And I'm not saying it doesn't add to it, but the real estate investor world is completely separate, and some of the most successful real estate investors I know have never been licensed, right? So you don't need it. It could actually be a deterrent in some ways because you get distracted to go do sales. So long story short, I'm going on, but I started my own brokerage to do my own thing. And because I led that same group that I initially got introduced to, I led that Chester County DIG subgroup for 10 years in Chester County here. And there was a certain draw from other agents experiencing that same thing from me, like, hey, my broker's not really teaching me the things that I want to learn, how to invest, how to really scale a portfolio, raise capital, find off-market deals, or financing subject to.
That's kind of like a big shift, right? Because I think a lot of people, you open a real estate brokerage, but you kind of had this shift from selling real estate, one-off, sales, to like a mindset of building generational wealth. And is that
for sure
kind of what you focus on? Like, when did you have that shift?
Well, I think some of it was like when you'd go to the real estate, nothing against like the board of realtors or anything like that, but you'd go to these realtor conferences and it was pretty stuffy. Everyone's wearing a suit back then or getting dressed up, trying to like look important, and and then you start talking to them and they don't have enough money to pay their taxes from their commissions from the previous year. I'm not saying they're divulge that, but like a lot of agents are on this treadmill, and I just watched it. And then I'd go to the real estate investor meetups, and one of the guys that I met there, he's rolling up in a little beat up old Toyota Camry with some junky jeans on and dirty shoes, and start talking to him. He's got 180 properties. And I'm not saying that I want to be that guy either. I think there's two extremes. But I saw that the real wealth isn't flashy. It's not all about ego, and it's not all about, having this huge Instagram following or this or that. It's more just buying and holding real estate. You're creating massive amounts of wealth in the background while everyone else is kind of chasing a commission here and there.
And I love that, with your brokerage, it seems like from the outside looking in, you're focused on, and you can kind of elaborate a little bit more on like helping develop the agents to have that mindset of like building wealth versus, you know, the transactional, like sell a house, get a commission, and, you know, go spend it.
Yeah, so and this is where, you know, your strengths become your weaknesses at some point, right? So initially our core group was just investors, but we scaled, we grew, we're about 125 agents. We closed, you know, last year about 900 transactions. We have a pretty decent market share in this area and we sell a lot of retail deals. So we almost like bottlenecked ourselves on the brokerage side. Fast forward to today where we do a ton of retail sales. We help a ton of first-time home buyers. We do a bunch of move-up buyers. We work with downsizers. We work with estates. Our team does a lot. It's just that my personal focus and where this has come from has been on the investing side. What we're really looking to do is marry the two, teach agents how to grow and scale their sales business, offer them a better commission split, better culture, better technology, but then teach them how to build that generational wealth and not just be stuck on that commission roller coaster forever. So, you know, we have all the tools for them to operate a retail sales business, scale it, grow it, but then what's next, right? Like we have that next step for them.
Fast forward, you know, kind of getting started in the business, then you know, move into starting the brokerage and doing these deals. You know, that's where you put in the work, right? That's where you kind of cut your teeth, you grind it out. And now I would imagine your business looks a little bit different today. So I want to talk about like, what does your business look like today?
Well, we have a couple businesses. So, you know, we have the real estate brokerage, mortgage, title, hard money lending, the investment portfolio, which is also quasi development. We do a decent amount of renovations, you know, sometimes over $1 million or $2 million in construction on our own projects in a year. So it's one of those things that's evolved where I hate the word vertically integrated because I can't say that's how it works. It's not very vertical, but it's more like an ecosystem or a terrarium of multiple businesses that do hopefully, you know, help feed each other. And sometimes when one is, you know, thriving, another one is suffering, right? But we have a real estate ecosystem for people to scale their business and create generational wealth when they're ready to transition out of the putting a sign in the yard on a Sunday afternoon, right? So that's really the goal, is to help them on that pathway to financial freedom when they've realized that it's not what they want to do forever. It's a very common saying. If you talk to realtors, they'll say, I don't want to sell forever.
Right. Yeah.
We're all going to die, so no one's going to sell forever. But do you have some time after that, you know, where you stop?
How are you helping people build generational wealth? Let's talk about, you know, some of the different ways that you're helping people with that.
Well, you know, in reality, most of this is like a mind game, you know, so you don't know what you don't know. And it's funny enough that most realtors are almost like harder to teach to invest than someone that's like new. Yeah, because what's going to happen is they're going to almost adopt this mindset that how we train our agents is to say, go talk to your lender, like, you know, Chris Swartz, right? Like, go get pre-approved, and then that's your purchasing power, and that's what you need to buy, and that's like a whole train of thought. Those neural pathways are already very ingrained, where I don't think like that. Like, I think my purchasing power is unlimited. It's just, what's the deal, and how do we get the money into the deal, right? So I kind of reverse engineer the way I look at it, and it's easier to teach that to someone that hasn't kind of been brainwashed, so to speak, that there's only one way to do something. That's just one piece of it, but I think the way that we do it, you know, we've been trying to invent like this proven process, right? But I try to replicate, how did I learn? I learned by being in a community, like for a long period of time on a consistent basis around people that are actually doing it. So that's how we help people, is created a collaborative community of people that are actually doing deals, flipping houses. I just got off the phone with one of my agents, and he's going to the bank and depositing a $300,000 check he did on one flip. He's like, dude, I just want to be by your side. Like, thank you so much for teaching me this stuff. Like, this is life changing. You know, that's how we do it. It's really just, I would love to say, look, Chris, there's this very specific process, but I genuinely believe it's just who you surround yourself with. You learn as you go. I know there's a book, it's like, you can't teach a kid to ride a bike at a seminar. You really can't. You can read Rich Dad, Poor Dad. You can read all these books. It's all helpful. It's all supplemental information. But if you want someone that's going to help you take action, you got to be in a room where you feel like you're missing out, you're getting left behind, and you're getting, like the same agent actually in the past said, he was peer pressured into success just by being in our circle. It's like, that's how we do it.
So it's more like an immersion, almost like, you know, it's like just being around the right people. And
you're in the
right
ecosystem.
rooms. Yeah.
Right.
When people get to that level and they start earning, because I know I meet with a lot of high earners, but they feel stuck. They're still broke. They're making more, but they're spending more. What do you do to kind of help, or what would you say to people, you know, the high earners, but they're still broke? I mean, because for me, smart money is about a lifestyle, right? And we're going to talk a little bit more about freedom and lifestyle, which is really where it gets fun. But if you're, a high earner, but you stay broke, I mean, what's the difference there between that and someone that's building generational wealth?
Well, I think it's a few different things. It's one is like there's a faith component, and I'm not talking about religious faith. And I think there's also like a gratification piece. I'll kind of break it down. When someone goes, if you wake up, and you're like a hunter, like I consider myself like a hunter. I'm out modern day, hunter gatherer, like, but instead of hunting meat, kind of hunting money, right? But hunting money is delusional in a sense because money is made up, right? So it's, I know inflation's not like been a major topic or anything, but you're chasing something that's completely made up. It actually has no value other than the value we've assigned to it. And you're actually running after something that if you look at the US debt clock or the way the economic financial system works, you're chasing something that if you need to put your time and resources in to make it, it's ultimately going to outpace you because you're going to slow down on that treadmill eventually. But I'm hunting assets. So I'm looking for assets. That's the big differential. And where you see, certain earners, what happens is like lifestyle creep. So you earn more, you spend more, you earn more, you pay more taxes. Where I buy more assets, I pay less taxes. I buy more assets, I work less. And because the assets are designed in a way where like real estate's not super liquid, you're not going to the ATM and pulling out cash out of a rental property. I mean, you can with a refi to an extent, but because it has that barrier, it's not that instant gratification where you can go and buy something. And where the faith component comes in is it's like, I'll forgo some money now that it's going to be there in the future. That's what I mean by faith.
Okay.
Between the faith component and the instant gratification is really where most people trip up on the mindset. And then they're on this hamster wheel. Like I truly adopted that rich dad, poor dad mindset. When I bought my boat, I went and bought more rental properties. When I bought my Hummer, I bought more rental properties. Those assets pay for my lifestyle. That way I'm not working for money. I'm working for assets and education.
I love that. And I think that's the big difference is just income versus assets.
It's really where it's at. Yeah. Yeah. If you chase income, you're just going to always be on that treadmill until you shift to buying assets that produce the income.
Yeah. I love that.
Rich Dad, Poor Dad, he breaks it down better than anyone else. And it's really great to play the board game. I play with my 7-year-old son, the cash flow for kids, because he already knows assets are better than liabilities.
I love it.
He's already trained his brain for the dopamine hits to get the green chips versus the red chips,
Oh, that's great.
And that's like where we just are trained wrong to go to school, get a good job, work hard, and then it's going to pay off. But what they don't teach you is that the money's losing value while you're losing time and energy to put more effort in to chase that same dollar.
Yeah, it's amazing that book and the whole philosophy, Rich Dad Poor Dad, like it's just so time tested, really basic, fundamental. But when you read that, it's a game changer. I mean, it really is. If anyone listening hasn't, read Rich Dad Poor Dad, you got to get through that and pick it up. It's very simple philosophies and concepts, but game changer.
And it's one thing to read it, and then the next thing to really like rewire your system.
Yeah, and I love that playing it, with your 7-year-old, introducing your kids to that concept, because for me, that's another area that I'm passionate about is I just feel like the education system is really lacking in educating our youth in the actual components that are going to propel them forward in day-to-day life. Like they give them all this book smart and this knowledge, but they fail to tell them how to balance a checkbook or income versus assets or how interest works. And, you get into college and it's like, yeah, sign here. Here's a student loan. Here's a credit card.
The system worked, and why do 95% of people that they're passing away with, debt, they're not financially free? At least 95% of our population will never reach financial freedom. So if the system worked, why are the stats like that? And it's easy to look around. I mean, we're blessed to live in a really abundant area, so we don't see it as much. But like most people are going to work their entire life, and they're going to work their entire life to make a paycheck. To me, it's much deeper. It's much more, higher level control of human population than just, the system's designed to get people to produce, right? So it's a reward system.
Produce and pay lots of taxes.
Yep. And we could talk about that if you want.
Yeah, well, I mean, let's talk about, a couple of things too. You're buying real estate. If somebody is getting started, and then we'll talk about some tax strategies, what are some of the biggest mistakes? Because I know what keeps people stuck is like, I don't know where to get started. I don't want to buy the wrong property. I don't want to buy the wrong area. I don't want to pay too much. So, like, what are the mistakes that cost people the most in real estate?
So, I've always said like you make your money when you buy it. You got to buy right, but you got to operate it right too. You can take a great deal and it can turn into a terrible deal if you don't know how to operate it. Meaning like you buy a great flip, but you don't know how to manage contractors, right? Or you get a really good rental property, but you don't know how to do property management and tenant screening, and you don't have enough cash reserves. So, I mean, the biggest risk in real estate, generally speaking, is debt. It's also the biggest lever. And, so debt is, to me, it can be your best friend or be your biggest nightmare, and it's all how you use it. Access to capital is probably the biggest thing that most people don't really think about that can catapult them to a whole nother level, right? So we have a mutual friend that lives on his boat down in Sarasota, right? And he's talked to me about just, why don't you just add a zero, and I would say 10 years ago, I was doing deals that are, say 400,000. Well, I just closed on one that's 4 million last Friday. So if you would have asked me 5 years ago, could you do that? I'd probably say no. But the real game changer there was access to capital. If you know the math and the math all is equal, then why don't you do a $4 million deal versus a $400,000 deal? If your percentage profit is the same, right? If your net is the same, then you might as well add a zero and scale it. So that's one of the biggest things that I think a lot of people try to stay small. Yeah, they try to stay small at the beginning, which is fine. Like, I'm glad that I didn't scale too fast and my portfolio crumble, but I also personally wish I would have taken a little bit more risk, learned to raise capital sooner. The biggest mistake is thinking that it needs to be your money. It does not need to be your money. Money needs to get into the deal, but it doesn't have to be yours.
So let's talk about it. If it doesn't have to be yours, like, how do you know that you've got the right deal, and how do you make confident decisions to go look for capital and know, okay, it's all right to take in this capital? Like, how do you make those confident decisions?
You're in the lending business, right? And when you get into commercial lending, and when I say commercial, if you're new, that doesn't necessarily mean it has to be commercial property, but let's say it's a rental property owned in an LLC with commercial debt. The commercial underwriting criteria will actually help you tremendously, because if the property has a 1.2 DSCR, 1.2 debt service coverage ratio, meaning that the rent is exceeding the expenses by 20%, essentially 120% of the expenses. So like you're $1,200 in rent, and then your principal, interest, taxes, insurance, whatever, maintenance, repairs, vacancy, that's at 1,000. Then you're at a 1.2 DSCR where it's exceeding that. That means there's some cash flow there, there's some meat on the bone. And then the other criteria is the 70% LTV. You could stretch to 75 depending on the market. But like if you stay in that general box, that 70% loan to value and your 1.2 DSCR, that is going to be a very rinse and repeat type deal. And what I try to do is I try to buy something discounted enough. Let's say you buy it 15% discounted, but you can improve the property and create an additional 15% of value. Now you have 30% of value. So essentially, if all things, you take out closing costs and certain carrying costs and things like that, that is like what you would call a clean burr, where you can kind of get in and out of the deal. Now, realistically, you're probably still leaving some money in the deal, but it's a rinse and repeat. Then you can look at, if I bring in outside capital, what is my cost of capital? Is it 8, 10, 12%? Is it, whatever it may be? And you can marry that private capital with institutional money or, bank financing, and essentially have no money in the deal. Where that other private capital can come from is the seller. So I've done some deals, over the last year or so, where I'm basically bringing no money to the table because the seller is the one that's basically putting up all my down payment. I had one where the bank was willing to lend 70% LTV, and they allowed for the seller to contribute 27.5%
Nice.
of my down payment in the form of a note and seller financing. So it was an IOU for me to the seller, right? The seller is really my biggest investor in the deal, and we structured that at a graduated interest rate at 1%, 2%, 3%, 4%, 5% over a 5-year period. But that allowed me to get into the deal with literally zero cash out of pocket. So it was $1.6 million purchase, $480,000 in a seller second position, $1,030,000, commercial debt, leaving me putting in 2.5%, which I don't know the number off the top of my head. The other piece was I charged a 6% commission. So the 6% commission covered the 2.5% plus the title insurance transfer tax. I walk out of settlement with the check, right? Literally none of my own money in that deal for a $1.6 million deal. I did another one for 3.2 million, similar structure. You can find these high leverage deals. They have to cash flow. There has to be some upside. And sometimes it's a management play. Sometimes it's, just improving the property or figuring out some extra way to increase the NOI through driving up rents or decreasing expenses.
If someone's listening to this and they're like, this sounds awesome. Like, wow, I can buy a $1.6 million deal with 2.5% of my own funds if I can.
None. It was
buy
zero. I walked out of settlement with the check.
even better, right? Yeah. Like, where does someone start to look for deals like that? Like, I know there's a million places and but just top level, like, how does someone find a deal like that?
They're all around you. It's just, did you make that offer? That deal doesn't fall in your lap. No one markets that deal. So you have to make the offer. And it's every single property if there's a seller that wants to sell and you're a buyer that wants to buy that property, then start thinking creatively outside the box of how to put the deals together. So creative deal structure is probably one of my unique strengths to bring the least amount of money to the table. I could have several $100,000 sitting doing nothing. And you might argue to me to say, well, why wouldn't you put that to work? I'd rather keep my brain active and figure out ways to put none of my own money in and have that money sitting as reserves. Just for me, I really like putting that puzzle together. And the goal for me is to put none of my own money in the deal.
Yeah, I love it. And, reserves, that creates freedom, right? And that's what we kind of talk about, that freedom of just kind of, traveling, doing what you want to do, being on your own schedule, because that you're covered. Like, no matter what happens, you have that safety and that security.
When you get into larger deals, you definitely need cash reserves, and you got to watch the debt that you sign, right? Like, you got to make sure that you understand the debt and what the cost is going to be, and can the property really support it.
Once you do all that, I know people are really interested in the tax strategies, and you have some great tools and strategies that you use, when you buy and leverage real estate to lower your income tax, right?
Yeah, so there's so many different layers. Like, if you go through what a lot of people don't realize, like, okay, they might understand a 401k, but they don't realize you can actually invest in real estate in a 401k, right? That's one, because the first line of defense is actually to reduce earned income for most people. And you can do that a couple different ways, but one would be maxing out your qualified plans. And by the way, I'm not a CPA, I'm not a financial advisor.
Get that out there.
I did just sit with a financial advisor that manages clients with 100 million, and he's like, your tax strategies are better than what we're implementing with some of these people. And I'm not trying to toot my own horn, but I've talked to other people, and it's like, this is what I'm going to lay out for you right here is pretty much like, I don't want to say a foolproof plan, but it'll take you from reducing your tax liability now, deferring for basically forever, and then you got to figure out your exit, and there's a couple different exits. But essentially, maximize your 401ks. So that's like the IRC 401 is the code for the 401k. You should read that and understand what that looks like. But a solo, as a self-employed real estate agent, you could be filing as an S corp, but you could also be having your S corp match your solo and, stocking away. I don't know the limits, but it's like maybe 70,000 a year between a company match. That's reducing your commission income. Simultaneously, once you start buying some rental properties, you want to file what's the IRC 469, and it's really just an election on the tax return that you check, but you need to meet the criteria. So talk to your CPA. You have to have 750 hours per year in real estate, 500 hours, which is material participation, and that allows you to what they say take passive losses against active income. So you have the ability to take unlimited losses on paper against active income. You can now offset your commission income with rental property losses, because previously, before you have the IRC 469 real estate professional election, you could take rental losses against rental income, but it can't offset any active income. This lumps your income together, passive and active, and allows you to offset them. Once you roll that, essentially, let's say you're making $300,000 a year. Well, you just have to show $300,000 a year in paper losses by buying real estate to accelerate the depreciation, offset those losses. Yeah, you're kicking the can down the road, but if you understand the time value of money and you take that money that was saved that would have went to the IRS and reinvest it, you start accumulating assets versus paying the IRS. So effectively, for most people, you're going to eliminate 25 to 30% of your tax of your income, because that's what you pretty much pay to the IRS. My federal tax return, I don't make any money, so I look like a terrible investor. It's not illegal. They laid out the map for you. They show you if you buy real estate, you can depreciate it. It's very simple. Straight line depreciation. We're doing cost seg, so we're accelerating it. You roll that, and then where you can get really creative is having a few different strategic partners and deals so that, everyone's kind of winning based upon the needs. So some people might need more tax benefits. Some people might want more of a depreciation or cash flow or whatever it may be. And you can slice and dice a deal and structure within an operating agreement. You could disproportionately share in the depreciation, which allows someone to,
Get what they need.
You might need the tax liability, and I'd rather have the capital in the deal and forego the tax write-off because I don't need it because I have more of it on another property. We could structure that internally. There's certain criteria, and it has to be like a substantive impact on the business. Like you can't invest $1 and I'll give you all the depreciation. But for example, I just had an investor invest $100,000 in a deal where I was able to offset $300,000 in depreciation for that $100,000 investment, which effectively wiped out a $100,000 tax liability from a Roth conversion. So that kind of goes back to that initial piece, which is you invest the money into your 401k, reducing your earned income. You start buying the rentals. You use the depreciation to do the conversions. Right now you have tax-free money growing in your retirement accounts. You have to continue to buy. It's part of the game. But then what you do is you trade up larger assets, 1031 into triple net or larger deals or whatever makes sense for your investment strategy. And then at the end, people can either sell or finance them, to reduce, like for the exit, they could reduce their tax liability that way. They could roll it into a DST, which is, that actually falls under the 1031 rules, but you're going into a fund that's designed to take a 1031. So you're passively investing at that point, or you could die and your heirs get a stepped up basis on the real estate. So that's kind of like the strategy that most people use. There's other complexities and things that you can layer in there, but that's the general rule. And I know I went through it fast so people could download this and
Yeah. I mean, that's gold right there. If you're listening to this and you're not using these strategies, I mean, this is gold right here. This is how you build wealth and you move away from, grind of earning income and paying a lot of taxes. Yeah, definitely.
Yeah, it might be boring stuff, but it's worth learning. So write down IRC 469, 401, 1031, 453. 453 is the seller finance, and then you could look at the personal primary residence exclusion, which I believe is like 121, and then you have 168, which is the depreciation. So if you understand those basic, IRS codes, you could Google them, you could chat GPT them, and it'll explain it to you on a first grade level. That's like, oh wow, and now you start layering these codes together. It's all there for you, and I just gave you, the cliff notes.
Yeah. Oh, that's awesome. This is great, Steve. And I know you have, some events, right, for people that are looking and thinking differently. How do they deploy their capital? Maybe they do have some money sitting. You have accredited investor events, right, where you can learn more and do a deep dive into that.
We typically have one a quarter. So we have one coming up this May. It's actually on advanced tax strategy. I believe it's full, but if you want to reach out and get on the waiting list, we don't charge for it. You do have to be accredited, so you have to meet the criteria. But if you want to reach out and get on the waiting list, if we have anyone drop out, we'll open up the space. We're keeping it to a small group of about 35 people.
And who are the people that should be in these rooms? Like who would benefit?
So, what's funny is a lot of people are like, well, I can't meet the real estate professional election, so you have doctors, lawyers, accountants, even sometimes I've had CPAs that, are like, well, we can't even take advantage of the same tax loopholes that you do as a real estate investor. What I would suggest is look at being strategic, and maybe it doesn't work this year, but especially if they're married and their spouse is a stay-at-home, whether it's a stay-at-home mom or dad, they could go get their real estate license, dabble in real estate a little bit, buy a vacation rental property. There's other ways that they can start take this depreciation and start offsetting your W-2, and you might be getting back a substantial check if you know how to strategize correctly. And you always have to run this all by your CPA, make sure your CPA is good with it, but the strategies are there. So it's really anyone who wants to scale and grow. They realize they're paying too much in taxes. They'd rather take that money that they're paying in taxes and put it in real estate. Yeah. You're getting the benefit because you're reinvesting back into an asset in this country that's, help fueling the economy and creating jobs. So that's why you get these tax write-offs.
That's great, man. And these are live events, right?
Yeah, in person. So we do it in Westchester. It's not recorded because we want people to just have an open conversation. When you start talking about money and taxes, people get all weird.
For sure.
We just like to have an open conversation. It's really about helping people strategize long-term. Obviously, we're not financial planners. We look at it more like we're financial friends and just trying to help each other all out and see how can we do this better and smarter and faster.
For people that want to get in the room and want to find you, Steve, what are some ways that they can connect with you? What's the best way to get involved?
I'm on social media, so I would just say reach out on Instagram or Facebook where I'd be most responsive. I'm on LinkedIn, but I'm not as responsive on there. You could also go to VRA Capital if you're an accredited investor and you have any interest in investing in the fund. It does pay 12% interest to, depending on the whole period and, what your goals are. You can either take distributions or you can have it compound through your retirement accounts, or it could be, just traditional money. That money's all deployed into local real estate, but I'm happy to hop on a call and go over our investment thesis with anyone that's interested in investing with us. And we're local, it's organic, so it's mostly through word of mouth, but our goal is not to become this big national REIT or anything like that, just a local real estate fund that invests in local real estate. And
local, where are you?
So the brokerage is licensed in PA, Delaware, Maryland, New Jersey, and North Carolina, but we're primarily focused in Chester County, Delaware County, Montgomery County. So right now that's where our investments are in terms of the core, but we're branching out, and we have stuff in Wilmington, a little bit in Jersey. Like I just closed on the 40 unit. It's pretty much anything that's within, say, a 45-minute driving distance to an hour max within the Westchester area, because I'm hands-on, so I'm not, the reason I buy hard assets is because they're tangible. I like tangible assets with the way things are going, so I like to be able to get my eyes on the projects.
All right, so Steve, it's been a pleasure having you on the show. You dropped so many great nuggets. And one of the things we do at Smart Money is I want to help people live life on their terms. So when I ask you, what does it mean to live life on your terms?
For me, it's really like time freedom. I think we all chase financial freedom, which is what I'm after too. But at the same time, what does that look like? For me, it's not buying the yacht or like the fancy car. I mean, I drive a nice car, like I have a nice life. I don't live super frugal, but I live well within my means. But for me, it's not about spending the money. It's actually about just having that flexibility with time and resources. Like I don't mow my lawn, I don't clean my car, I don't do my dishes. Like I pay for things around me so that I have my time back. And I think financial freedom allows me to buy my time back so I can focus it on the things that matter the most, which is to me my 2 sons and my mom. And then also being able to like just go grab lunch with someone whenever I want and pour into someone because I feel like I can make a difference and give back. So like the impact piece is huge to me. Financial freedom is great, but it's much more fulfilling if you help other people do it. Like hearing that phone call from one of my agents who has become a close friend, that's more fulfilling to me than when I would make $300,000. I mean, that $300,000 check doesn't mean anything to me, but for hearing him, how excited he is, I get to live vicariously through the people that we get to impact. So
yeah, that's what it's about. Well, hopefully through this podcast, we can get this out there and create that ripple effect and have an impact on anyone that's listening. So thanks again for jumping on.
I appreciate the opportunity.
Yeah, absolutely. Well, if you got something out of this, make sure you like and share it and pass along to somebody you know.
Thanks, Chris.
Follow Smart Money with Chris Swartz for more conversations on building wealth with purpose. And if you found value in this episode, share it with someone you know who can benefit, because real wealth is life on your terms.